Here's the afternoon showing the 1:30 to 4:15 time window. Last hour of trading, we'll look at that in a moment. Fair value gap in here, we trade up into it here. We break down, return back to the fair value gap, create another smaller fair value gap. This is a short, that's a short. Sell side below here, rips into it here. If you take this high to that low, expand that lower as a measured move, create this low in your mind as a fulcrum point. The range high to that range low, multiply that, then project it lower equally, and you'll get the range lows that we're seeing here. I told you to use the fair value gap last night in the Twitter space and outlined the very levels, and 49.43.75 was the actual tick low. You can't improve upon that. That's it, hitting it right there. And the market closes at 4:15. Now, after hours, it does trade lower. I don't care about that. I'm teaching you how to operate. At the last portion of the day at 1:30, if you're bearish, you can use the opening price at 1:30. Treat that the same way I teach you to use it on the midnight candle in New York, and at 8:30 and at 9:30. If you're bearish, the market rallies above that opening price, goes into a premium array, as we see here. You can expect this to do what? Sell off, and treat this whole price movement the same way I teach Power 3 for a daily chart. You can treat the same idea of Power 3 within a session. So everything is fractal. The algorithm sees it just like this. Opening price, this is a Judas swing. It's all manipulation. Up into a premium, trades lower, rallies back to the short-term premium array, trades lower, fair value gap, trades up into here. This low being taken out here, this is model 2022 right here. Now think, I teach you to trade this at the 9:30 opening, right? Everything is the same. We're just applying it to the market in small little segments the same way my algorithm does. So the logic the algorithm's using is it's using the protraction from this opening price when it's bearish and it still has undelivered targets down here. It's running up, creating a short-term overbought. We don't need an indicator to do that. Trades down, one more time up into a fair value gap, and then because of that, it creates that short-term low. It breaks below that short-term low, fair value gap, your eye goes right there, from this high down to that low, midpoint equilibrium. So you're looking for a fair value gap at or above equilibrium. Where is it at? There. Trades up into here perfectly. Breaks down. Here's a wick. Where's it trading up to? Midpoint. Right there. There's another sell. So you can sell here, pyramid, wait for sell side to be broken there. We're partial, which is the top of the fair value gap on the daily chart. Trades down into midpoint, consequent encroachment. That's a partial. And then as it hits here, you don't want to use the low of a fair value gap for your target or partials. You always want to come off of that a little bit. Anywhere between a half a point to a full point, you'll always see me try to do that at the very minimum. Anything more would be, if I have a lot more targets below, which there wasn't below this for me, I would not try to be fancy dancing a perfect exit at the low tick. It's just, there's no need for that. This is a 1 minute candle. It only goes down there, bam, for 1 second, it's off of it. And the 1 minute chart in the afternoon session, here's that fair value gap from the 5 minute chart inside the New York lunch hour. Extended it out in time. We trade up into it here. We shift lower. Fair value gap trades back up into it here. We break down. Remember I said once that low was taken out in the afternoon, after it ran up here, once that low is taken out, which it does here, that's a shift in market structure below the 5 minute low. We're seeing it on these individual 1 minute candles. Your eye goes back to what? The 5 minute fair value gap, which is this rectangle here. You may be looking at this and saying, well, what's that anchored to? It's anchored to this right there. These two lows here on the 5-minute chart are those single lows on the 1-minute chart that are separated a little bit wider because I had the chart zoomed in. And this run right here is back into the 5-minute fair value gap. Refer to these 2 points here, these 2 lows and this high. Refer to this rectangle. Think about where we're at, showing this and this with this rectangle. Now watch when we go into the 1-minute chart. That's these 2 equal lows on the 5-minute chart. When price goes below that, that's a shift in market structure. And then returning back up into that fair value gap, which this rectangle represents the imbalance or fair value gap on the 5-minute chart. I just dropped to a 1-minute chart, and this level is transposed to the 1-minute chart, and it's going to show all the individual 1-minute candles. That's that return into the 5-minute fair value gap. That sell right there. And then here's that run back up into the middle of the wick. You don't see a wick here until there for this time frame, but this is all a wick on the 5-minute chart. And it's trading up here into about half of that wick. And then it breaks down, creates a fair value gap here. Here's another partial. How are you getting in here and doing all these partials? You're not seeing every time frame I'm looking at. I'm looking at a 1-minute chart. I'm looking at a 30-second chart. I'm looking at a 15-second chart. So I'm looking for all these things. Once I'm in the right side of the marketplace, I'm going to be hammering. As long as I have room to build in the position, I have equity to use and within my risk model, then I'll take every premium array that it gives me. Fair value gap breaks down. This is an old daily low, as you can see here. But here's another signal forming around a daily low. Just because it goes back up to that old daily low, and if I'm bearish, that's not enough for me. Like I have to see something like this fair value gap. I got to see something like an institutional order flow or a bearish breaker. You know, if I don't have a PD array that the algorithm is going to refer to, just because we're below an old daily low and it returns back to it doesn't mean it's a sell. Just because we went above an old high and trade back down to it, that's not necessarily a support or a high probability long entry. But you can't just simply say that what I'm showing you is support resistance. I'm showing you what makes support resistance what it is in reality. Imbalances, fair value gaps that get traded to, and when they return back to them later on, that's a real support and resistance level. It's finite. It's not a zone, like a supply and demand zone. It's a very specific level. And there has to be logic, and it has to occur around a specific time. When this occurs here with this fair value gap, and it trades up into it here, what time of day is it? It's during the final hour of trading, between 3 p.m. and 4:15. So this run here, opening price, extending out in time. This is a Judas swing, trades up into a fair value gap, breaks down. Fair value gap, trades up into it, last hour of the day, displacement at a old daily low. There's lots of liquidity that comes in around daily highs and lows. So one of the best things you can do is use your daily chart and use daily highs and lows over the last 3 days. So you look back for daily highs and lows for algorithmic trading. So in short, today, whatever day it would be that you'd be entering the trade, that's day 1. Yesterday is day 2, and the day before yesterday, whether it be going into the previous week, Friday, or whatever the previous day is, that's day 3. You have the highest high and the lowest low of that total range. You have the individual highs and the individual lows. That is a dynamic matrix of liquidity that you will never exhaust for future trade setups, because it's just brilliant. You can see them forming all the time. And this is what it kind of looks like right in here. This is a model. This is a specific PD array aligned with an old daily low while bearish. Time of day, last hour trading. So the market runs up, fakes people out, think it's going to low. It's been put in, market breaks down, returns back to a fair value gap, sells off aggressively. Look at the bodies of the candle respecting the fair value gap high. Folks, that's algorithmic. That right there, that's a signature proving what I'm teaching you, that price engine is delivering price based on these very things I have codified. You are seeing the evidence of it. It's undeniable. Then it drifts. The high is the exact high of the fair value gap. The high of this candle is the exact high of the fair value gap. It breaks. Fair value gap. Trades down. Midpoint of the fair value gap, high and low. Consequent encroachment. It reacts to that. Back up to what? The fair value gap. Stops midpoint of that. Consequent encroachment. Trades lower. Comes right back up. Where's it stop? At the bottom of the fair value gap, which is this candle's high. Perfectly. It stops in the midpoint. It stops at the low point. Not some ambiguous level in some supposed supply zone. I am teaching you technical science, not retail mumbo jumbo. I'm sorry if that hurts your feelings, but I have to sometimes grab you by the lapel and shake you and say, look, pay attention. The details here, you can't argue with them. I didn't have to teach this to you. I didn't have to bring it out to the public. And I'll be honest with you, there are some days where I wish I would have never done it. And I feel guilty by feeling that. I do, because I know I've been gifted with it. And I also know that there are people out there that if they were in my position, they would be abusing it. And I'm trying to be a good steward with it. And once it leaves this fair value gap, where's it go? Right down to the fair value gap low, to the tick, and stops. Trades back up. Where does it stop here? Midpoint of the fair value gap right there. Consequent encroachment. Stop. What's the chances of that being just buying and selling pressure and they just happen to be right? The trader that goes into the marketplace here, the buyers and sellers right at that price. What's the chances of them just being exactly where the algorithm is going to reprice to for that very logic? What's the chances of the trader meeting another trader right at that price right there to give that tick right at the bottom of that fair value gap? What's the chances of two traders coming together to meet at the consequent encroachment midpoint perfectly right between this candle's low and that candle's high? What's the chances of that randomly happening? What's the chances of every one of these candles open and closes to be exactly on that fair value gap high? What's the chances of that? What's the chances of that candle stopping dead in its tracks right to the tick at the fair value gap high and this one as well? Folks, listen. At some point, it's absurd to arm wrestle this. It is what it is. And it's my interest for all of you is to just use the information I'm providing you to make changes in your life while you can. I don't want to engage in those types of movement. I want to be in when the market's really predisposed to be free to move. Give me 10 handles. Give me 10 handles of a range. Then I'll operate. Then I'll engage. Then I'll go in and participate. I can do a lot of these small little micro moves. What would that look like? Well, we have a fair value gap here. Trades up into that. And let's just say that I don't believe at this moment that it was going to go down to this level here. But I do see this as a sell. How would I trade that? I would look for this low to be taken out right there. So that would be my trade. Going here to here. That's a very, very small little micro range. But that's 2.5 handles that you can get right there. And then do the same thing somewhere else. So there's 2.5 handles there. And there's your 5 handles for the day. But that's not a lot of money. It's only $250. Right. But when you're doing it with 10 contracts, it's $2,500 per day. You have to think modularly. Small little pieces of the elephant is how you devour it. You don't try to swallow it in one bite. Small little incremental moves. And find consistency going in looking for these surgical strikes that repeat over and over and over again.